After studying this module, you will be able to know the concept of recognition and measurement, learn the different assumptions and principles of recognition and measurement, identify how to measure different financial statement elements, and understand the role of international financial reporting standards. To begin with, let us first discuss the concept of recognition and measurement. There are various elements of financial statements. These should be recognized or recorded and measured. SFAC 5 addresses these issues. Recognition refers to the process of admitting information into the basic financial statements. Measurement, the process of associating numerical amounts to the elements. For example, revenue was previously defined as an inflow of assets from selling a good or providing a service. According to SFAC 5, an item should be recognized in the basic financial statements when it meets the following 4 criteria subject to a cost effectiveness constraint and materiality threshold. Number 1, definition. The item meets the definition of an element of financial statement. 2, measurability. The item has a relevant attribute measurable with sufficient reliability. 3, relevance. The information about it is capable of making a difference in user decisions. 4, reliability. The information is representationally faithful, verifiable and neutral. These obviously are very good guidelines. The concept statement does not address specific recognition issues. Measurement. The question of measurement involves 2 choices. Number 1, the choice of a unit of measurement, and number 2, the choice of an attribute to be measured. SFAC 5 essentially confirmed existing practice in both of these areas. The monetary unit or measurement scale used in financial statements is nominal units of money without any adjustment for changes in purchasing power. In addition, the board acknowledged that different attributes such as historical cost, net realizable value, current or replacement cost, current market value and present value of future cash flows are presently used to measure different financial statements elements, and that they expect that practice to continue. Number 1, historical cost. Amount paid to acquire an asset or liability, the amount received when the obligation is incurred. For example, property, plant and equipment are measured at historical cost. 2, current or replacement cost. Amount needed to acquire an equipment asset. Number 3, net realizable value. Amount of cash, sometimes the present value minus collection and the other cost incurred. For example, accounts receivables are measured at their net realizable value. 4, current market value. Amount of cash received from an immediate sale of an asset. 5, present value of future cash flows. Amount of cash to be received, distributed at the appropriate interest rate. For example, most long-term liabilities such as bonds are measured at the present value of future cash payments. Present value measurements have long been associated with accounting valuation. However, because of its increased prominence, present value is the focus. A recent FASB concept statement that provides a framework for using future cash flows as the basis for accounting measurement and also asserts that the objective in valuing an asset or liability using present value is to approximate the fair value of that asset or liability. Answers to the recognition and measurement questions are embedded in Generally Accepted Accounting Principles SFAC 5, confirmed some of the more important of these principles used in present practice. GAAP consists of broad principles and specific standards. The accrual accounting model is an example of a broad principle. Moving further, let us now discuss the accounting assumptions. Before addressing additional key board principles, we should look at some important assumptions that underline that fundamental principle. A group of assumptions have been established in the field of accounting. These assumptions are the basics of financial accounting. At the same time, assumptions are not accounting principles as they are more agreed upon rules. The four basic assumptions underlining generally accepted accounting principles are: number 1, the economic entity assumption. The economic entity assumption presumes that economic events can be identified specifically with the economic entity. The accountant keeps all of the business transactions of a sole proprietorship separate from the business owner's personal transactions. For legal purposes, a sole proprietorship and its owners are considered to be one entity, but for accounting purpose, they are considered to be two separate entities. 2. The going concern assumption. Financial statements of a company presume that business is a going concern, meaning that the business is going to be operated for non-predefined period. In other words, there is no ending date for business life. The accounting principle requires companies to use the accrual basis of accounting. The matching principle requires that expenses be matched with revenues. For example, sales commission expenses should be reported in the period when the sales were made and not reported in the period when the commissions were paid. Wages to employees are reported as an expense in the week when the employees worked and not in the week when the employees are paid. If the company agrees to give its employees 1% of its 212 revenues as a bonus on January 15, 2013, the company should report the bonus as an expense in the year 2012 and the amount unpaid at December 31, 2012 as a liability. The expense is occurring as the sales are occurring. Because we cannot measure the future economic benefits of things such as advertisements, and thereby we cannot match advertisement expenses with related future revenues, the accounting charges the advertisement amount to expense in the period that the advertisement is run. 3. The periodicity assumption. The periodicity assumption allows the life of a company to be divided into artificial time periods to provide timely information. This accounting principle assumes that it is possible to report the complex and ongoing activities of a business in a relatively short, distinct time intervals, such as the 5 months ended May 31, 2012 or 5 weeks ended as on 1st May 2012. The shorter the time interval, the more likely the need for the accountant to estimate amounts relevant to that period. For example, the property tax bill is received on December 15 of each year. On the income statement for the year ended December 31, 2011, the amount is known, but for the income statement for 3 months ended On 31st March 2012, the amount was not known and an estimate had to be used. It is imperative that the time interval or period of the time be shown in the heading of each income statement, statement of stockholders' equity and statement of cash flows. Labeling one of these financial statements with December 31st is not good enough. The reader needs to know if the statement covers the 1 week ended December 31st, 2011, the month ended December 31st, 2011 and the 3 months ended on December 31st, 2011 or the year ended as on December 31st, 2011. 4. The monetary unit assumption. The monetary unit assumption states that financial statement elements should be measured in terms of dollar. Let us now discuss the accounting principles. The 4 important broad accounting principles are here which deal with the critical issues of recognition and measurement. The accrual accounting model is embodied in each of the principles. These principles provide significant guidance for accounting practice. 1. Historical cost principle. It states that the assets and liability measurements should be based on the amount given or received in the exchange transaction. Historical cost measurement provides relevant cash flow information and also is highly verifiable. A departure from historical cost valuation sometimes is appropriate. Number 2. The realization principle, also known as the revenue recognition principle. Revenue should be recognized when the earnings process is virtually complete and collection is reasonably assured. Both revenue recognition criteria usually are met at the point of sale. Revenue is recognized when earned regardless of when cash is actually received. The revenue recognition principle and matching principle are 2 cornerstones of accrual accounting. Both determine the accounting period in which revenues and expenses are recognized. According to the revenue recognition principle, revenues are recognized when they are realized or realizable and earned, usually when goods are transferred or services rendered, regardless of what and when cash is received. In contrast, cash accounting revenues are recognized when cash is received, regardless of when goods or services are sold. Cash can be received before or after obligations are met. When goods and services are delivered, related revenues as 2 types of accounts. Accrued revenue. Revenue is recognized before cash is received. Deferred revenue. Revenue is recognized after cash is received. Accruals and deferrals. Timing of recognition versus cash flow. 2 types of balancing accounts exist to avoid fictitious profits and losses. These might occur when cash is not paid out in same accounting period in which expenses are recognized. According to matching principle, in accrual accounting expenses are recognized when obligations are incurred, regardless of when cash is paid out. In contrast to recognition is disclosure. An item is disclosed when it is not included in the financial statements but appears in the notes of the financial statements. Cash can be paid out in an earlier or later period than the period in which obligations are incurred. Related expenses result in the following 2 types of accounts. Accrued expenses. Expense is recognized before cash is paid out. Deferred expenses. expense is recognized after cash is paid out. Accrued expenses are a liability with an uncertain timing or amount. The uncertainty is not significant enough to qualify it as a provision. One example would be an obligation to pay for goods or services received from a counterpart, which cash is paid out in a later accounting period when its amount is deducted from accrued expenses. In accounting, recognition of revenues and expenses is based on matching principle. Let us quickly revise the concept of revenues and expenses. Accrued revenue. Revenue is recognized before cash is received. Deferred revenue. Revenue is recognized after cash is received. Accrued expense. Expense is recognized before cash is paid out. Deferred expense. Expense is recognized after cash is paid out. The matching principle is a culmination of accrual accounting and revenue recognition principle. They both determine the accounting period in which revenues and expenses are recognized. According to the principle, expenses are recognized when obligations are: number 1, incurred, usually when goods are transferred or services rendered or sold, for example. Number 2, offset against recognized revenues which were generated from those expenses, for example, related on the cause and effect basis, regardless of when cash is paid out. In cash accounting, on the other hand, expenses are recognized when cash is paid out, regardless of when obligations are incurred through transfer of goods or render of services. Next, if no cause and effect relationship exists, for example, a sale is impossible, cost is recognized as expense in the accounting period in which it expires, when it has been used up or consumed. Prepaid expenses are not recognized as expenses but as assets until one of the qualifying conditions is met, resulting in recognition as expenses. If no connection with revenues can be established, costs are recognized immediately as expenses. For example, general administrative and research and development costs. Next, prepaid expenses such as employee wages or subcontractor fee paid out of promised are not recognized as expenses but as assets until the actual products are sold. The matching principle allows better evaluation of actual profitability and performance. It reduces noise from the timing mismatch between when costs are incurred and when revenue is realized. Keep in mind that recent standards have moved away from matching expenses and revenues in favor of balance sheet model of reporting. 4. The full disclosure principle. Any information useful to decision makers should be provided in the financial statements subject to the cost effectiveness constraint. Now that we have discussed the basic accounting concepts, we shall now discuss Indian accounting standards. Indian accounting standards, abbreviated as AS, are a set of accounting standards notified by the Ministry of Corporate Affairs which are converged with international financial reporting standards which are known as IFRS. These accounting standards are formulated by Accounting Standards Board of the Institute of Chartered Accountants of India. Now, India will have two sets of accounting standards, namely existing accounting standards under Companies Accounting Standards Rules 2006 and IFRS converged Indian accounting standards with Indian accounting standards. The Indian AS are named and numbered in the same way as corresponding IFRS. NACAS recommend these standards to the Ministry of Corporate Affairs. The Ministry of Corporate Affairs has to spell out the accounting standards applicable for the companies in India. As on date, the Ministry of Corporate Affairs has notified 35 Indian accounting standards, but it has not notified the date of implementation of the same. The basic objective of accounting standards is to remove variation in the treatment of several accounting aspects and to bring about standardization in presentation. They intend to harmonize the diverse accounting policies followed in preparation and presentation of financial statements by different reporting enterprises so as to facilitate intra-firm and inter-firm comparison. The total 32 accounting standards are the mandatory accounting standards as on 1st July 2012 as listed on the site of the Institute of Chartered Accountants of India. Accounting Standard 30 Financial Instruments Recognition and Measurement issued by the Council of the Institute of Chartered Accountants of India comes into effect in respect of accounting periods commencing on or after 1st April 2009 and will be recommendatory in nature for an initial period of 2 years. This accounting standard will become mandatory in respect of accounting periods commencing on or after 1st April 2011 for all commercial, industrial and business entities except to a small and medium sized entity as defined. Moving on, let us now discuss International Financial Reporting Standards. International Financial Reporting Standards are designed as a common global language for business affairs so that company accounts are understandable and comparable across international boundaries. They are a consequence of growing international shareholding and trade and are particularly important for companies that have dealings in several countries. They are progressively replacing the many different national accounting standards. The rules to be followed by accountants to maintain books of accounts which is comparable, understandable, reliable and relevant as per the user's internal or external. IFRS began as an attempt to harmonize accounting across the European Union, but the value harmonization quickly made the concept attractive around the whole world. They are sometimes still called by the original name of International Accounting Standards. IAS were issued between the year 1973 and the year 2001 by the Board of International Accounting Standards Committee. On 1st April 2001, the new International Accounting Standards Board IASB took over from IASC the responsibility for setting international accounting standards. During its first meeting, the new board adopted existing IAS and Standing Interpretations Committee standards. The IASB has continued to develop standards calling the new standards International Financial Reporting Standards. According to the list of IFRS, recognition and measurement is also an accounting standard called as IAS 39 Financial Instruments. It outlines the requirements for the recognition and measurement of financial assets, financial liabilities and some contracts to buy or sell non-financial items. Financial instruments are recognized when an entity becomes a party to a contractual provision of the instrument, and are classified into various categories depending upon the type of instrument, which then determines the subsequent measurement of the instrument, typically amortized cost or fair value. Special rules apply to embedded derivatives and hedging instruments. IAS 39 was reissued in December 2003. It applies to annual periods beginning on or after 1st January 2005 and will be superseded by IFRS 39 financial instruments once a mandatory application date of that standard is determined. The release of IFRS 39 Financial Instruments 2013 on 19th November 2013 contained on stated effective date and contained consequential amendments which removed the mandatory effective date of IFRS 9 and IFRS 9 which was given in 2009, leaving the effective date open but leaving each standard available for application. Accordingly, these amendments apply when IFRS 9 is applied. Let us now recapitulate what we have learned in this module. Recognition refers to the process of admitting information into the basic financial statements. Measurement is the process of associating numerical amounts to the elements. For example, revenue was previously defined as an inflow of assets from selling a good or providing a service. Accounting standards, 30 financial instruments, recognition and measurement issued by the Council of the Institute of Chartered Accountants of India. The basic objective of accounting standards is to remove variation in the treatment of several accounting aspects and to bring about standardization in presentation. IFRS are designed as a common global language for business affairs so that company accounts are understandable and comparable across international boundaries. According to the list of IFRS, recognition and measurement is also an accounting standard called as an IAS 39 financial instruments. IFRS began as an attempt to harmonize accounting across the European Union, but the value of harmonization quickly made the concept attractive around the whole world. They are sometimes called still by the original name of International Accounting Standards. IAS 39 was reissued in December 2003, applies to annual periods beginning on or after 1st January 2005 and will be superseded by IFRS 39 financial instruments once a mandatory application date of the standard is determined.